so this video is the 2020 costing video, and this year it was on marginal and absorption costing. So we had a part A and we had a part B. So reading down through part A now, it says Whelan Limited produces a single product. The company's profit and loss account for the year ended 31st the 12th, 2019, during which 26,000 units were produced and sold, was as follows. So you've got 26,000 units there in the sales, €1,040,000. You've got materials, €221,000. Direct labour, €364,000. Factory overheads, €166,000. Admin expenses, €115,500. Selling expenses, €87,900. Total expenses then, €954,400, and a net profit of €85,600. So the materials and direct labour are variable costs. Apart from a sales commission of 6% of sales, selling and administration expenses are fixed. Factory overheads and mixed costs have behaved in the past as follows. Okay, they are mixed costs and have behaved in the past as follows. So year ended 31st the 12th, 2018, we have a production of 21,000 units and the factory overheads in euros, 148,500. The year ended 2017, you had 16,400 units and €132,400. And then the year ended 2016, 13,800 units and €123,300. So what is required? Part 1. Calculate the variable and fixed elements of factory overheads using the high-low method. Part 2. Calculate the break-even point and margin safety for Whelan Limited. Part 3. Calculate the number of units that must be sold at €45 per unit to provide a profit of 15% of the sales revenue earned from these same units. Part 4. Calculate the profit Whelan Limited would make if it reduced its selling price by 5%, increased fixed cost by 4%, and increased the sales commission percentage to 7%, and thereby increasing the number of units sold by 20%, with all other cost levels and percentages remaining unchanged. And part 5, explain what is meant by a step fixed cost and give an example. Okay, so first part there, calculate the variable and fixed elements of factory overheads using the high-low method. Oh, sorry, looking at part B first. We'll take a look at that when we get to that. So that's the marginal and absorption costing part. So calculate the variable and fixed elements of factory overheads using the high-low method. So we'll just get straight into part A first. So mixed costs have elements of fixed costs and variable in them. Okay, fixed costs remain the same, doesn't matter what the output is, and variable costs change with the output. Okay, if the output changes, variable cost changes. So how do we separate these? So we separate these using the high-low method. Okay, and for us to find, we'll find the variable cost first. And why do we do this? How do we know? Why do we find the variable cost first? So because then we'll be able to find out the fixed cost. But the difference between the high output and the low output must be variable, because the fixed is staying the same. Fixed stays the same whether you're at 21,000 units in output, 16,400 units in output, 13,800 units in output. So they're always the same there. So any difference between the different levels of output has to be variable. So we're going to use the high-low method in order to find out the variable and the fixed elements of the factory overheads. So the output in units here, we've got 21,000 is the high, 13,800 is the low, and so the difference there is 7,500 units. And the factory overheads, the high is 148,500, the low is 123,500, and so the difference there is €25,200. So if we divide the 25,200 by 7,500 units, we get that the variable cost per unit is €3.50 variable cost per unit. We then take that information, the €3.50 variable cost per unit, and we multiply it out, right, by the individual number of units here. We multiply them by €3.50 to find out what the variable costs are. So look, we have the total costs here, the 148,500, the 132,400 and the 123,500. If we multiply then the number of units by 350, okay, we'll get, so 21,000 by 350 is 73,500. 16,400 multiplied by 350 is 57,400. And 13,800 units by €3.50 is 48,300. When we take all of them away from the total costs, we get that the difference there is €75,000 across the board. So the variable cost per unit, €3.50, the fixed cost, 75,000. Okay, so that is using the high-low method. Okay, so back to this now that we know those variable and fixed costs, right? So the variable was 350, the fixed is 75, okay? So now that we know that, okay, we know that 350 was the in factory overhead, so 350 is the variable, and then the fixed cost was 75,000, okay? Now, looking at the rest of the question again, right, so we have read it already, but 75k there is the fixed. Okay, so the materials and direct labour are variable costs. So materials variable, direct labour is variable. Okay, so we know what element of the factory overheads are variable. We know that 75,000 is fixed. Now, apart from a sales commission of 6% of sales, selling and administration expenses are fixed. So admin expenses, I hope you'd note that admin expenses are fixed. The sales commission will be in the selling expenses. So 6% of the sales figure, 1,040,000, will be variable. Okay, so let's just have a look. So this is our marginal costing statement. Okay, we have to do one of these at the very start of a marginal costing question. And when we have this done and we take great care in doing it, the rest of the questions should be very easy for us. Okay, so looking at our sales in units, we've got the 1,040,000, so we have that there. We're breaking it down now to a per unit price as well. And so we've got €40 is the selling price there. Now, less variable costs. So we've got the 221,000 euro, we've got €364,000, and we've got in the factory overheads, you can see we've multiplied the €26,000 by the €3.50 variable that we found out using the high-low method. And so that makes €91,000. And then for the sales commission, so 6% of sales, so it was 6% multiplied by the 104,000, and we got €62,400. So all of these are our variable costs, okay? So they all tot up then to €738,400, okay? When we divide that, 738,400 by 26,000 units, we get €28.40 is our variable cost per unit. Now, when we take that away from the 104,000, we get a contribution of 301,600. When we divide that by 26,000 units, we get €11.60. That is the contribution per unit. Okay. Then we have the fixed cost. So the factory overheads, we have the 75,000. 75,000 is the factory, the fixed element of that. Sorry, forget about this, 260 by 50. So 75,000 is that. The admin expenses is 115,500 and the selling expenses is 25,500. How do we get the 25,500? Well, from the 87,900, we have the sales commission of 62,400. So 87,900 minus the 62,400 is equal to the selling expenses of 25,500. So that's how we got that figure. When we add all of them together, we get €216,000 for the total fixed costs. And so our contribution minus our fixed cost then is equal to our profit of 85,600. Okay, so that's the marginal costing statement. Just taking a look now at the per unit basis, right? The per unit here, we said it was €40 selling price per unit. The 738,400 divided by 26,000 units is €28.40 variable cost per unit. And the contribution per unit then, 301,600 divided by 26,000 units is €11.60. Now, what am I doing here with this here? How do I get this? I have to work out what my variable cost per unit without sales commission is, because if I have sales commission in this question and the selling price changes, it is very likely, that, my variable cost is going to change. Selling price isn't €40 all of a sudden, your variable cost per unit is going to change. So you're going to have to figure out what the new sales commission would be on a new price if that scenario came up. So you always have to work out what is the variable cost per unit without sales commission as well. And you'll see how that's going to work now. You'll see how that happens as we go through the question. So that's the marginal costing statement. Great care has to happen here, and apologies that working in that bracket is not correct, so just forget about that, working beside the factory overheads going forward, so I'll just get rid of it here. So first part of the question, calculate the break-even point and margin of safety for Whelan Limited. So break-even point, what is the point? How many units do they have to sell before they start making a profit, or how many units do they have to sell in order to cover all their costs? So the break-even point formula is fixed costs divided by contribution per unit. So my fixed costs are here, 216,000, divided by contribution per unit, which is €11.60, and that gives you €18,620.68 units. Now we cannot sell 0.68 of a unit, so we will have to round up, so it'll be 18,621 units. So 18,621 units. So that is the break-even point. All right, now next, margin of safety. So margin of safety is your total sales, so 26,000 units minus the break-even point that we got in the last part, which is 18,621 units, and that is a difference of 7,379 units. So that is the margin of safety. That is how many units your sales can fall, before you start making a loss. So the margin of safety, you're safe, for 7,379 units. You won't start making a loss, until after that point. So that is part 2 done. Part 3 now says calculate the number of units that must be sold at €45 per unit to provide a profit of 15% of the sales revenue earned from these same units. Calculate the number of units that must be sold at €45 per unit to provide a profit of 15% of the sales revenue earned from these same units. So you might have to read things a couple of times, Now, this is our sensitivity analysis. What if we did this? What if we did that? So it helps management make decisions, on what the best course of action to do would be. What would your profit be if you did this? What would your sales price have to be if you wanted to increase your fixed costs but keep the profit the same? All these what if scenarios. So what we'll do first, we're going to write out the formula. So sales less variable costs less fixed costs is equal to profit. So this formula, it's very important. You're going to use it the entire time, And what this question is basically just an algebra question, You're going to let what you're looking for to be X, So in this case, the number of units is going to be X, Now, so if we don't know the number of units, we don't know what the sales is going to be, but we do know that the €45, they want to do it at €45. Okay, so you're going to have €45 multiplied by X number of units. Now, how many must they sell to provide a profit of 15% of the sales revenue earned from these same units? Okay, look, no change to variable costs apart from the fact that the selling price has changed from 45 up to 50. So therefore, we're going to use the €26 and we're going to work out what is 45 multiplied by 6%. So you have to say, right, €45 multiplied by 6%, that is €2.70 that they would be getting on each unit if they sold. So €45 multiplied by 6% commission, okay, is going to change the commission amount up to €2.70. Previously it was €2.40 here when the selling price was 50, but because it's changed up to 45, the sales commission has changed up to €2.70. Now there is no change to the fixed cost, so the fixed cost $216, that has stayed the same. Okay, and now they want to get a profit of 15% of the sales revenue earned from these same units. And what units? It's the 45 multiplied by the X. So we have to find out, right, what's 45 multiplied by X? And 45 by 15 is 6.75X. So that's the profit that they want to earn. They want to earn 15% of that sales revenue, so 675X. So if we multiply it all out, then we're going to have 45X minus 28.7X minus 216,000 is equal to 6.75X. So what we're going to do, we're going to get all the X's over to one side and the euros over to the other side. So we'll have 45X minus 28.7X minus 6.5X, and then we'll bring the 216 over, and that will make that a positive. So we're going to work out that that is 9.55X is equal to 216,000. And then the number of units then, when you work that out, 22,618 units. Okay, so 22,618 units, and that is part 3 complete. Okay, moving on to part 4 then. Calculate the profit Whelan Limited would make if it reduced its selling price. Okay, going to get rid of that mistake there again. If it reduced the selling price by 5%, increased fixed costs by 4%, and increased the sales commission percentage to 7%, and thereby increasing the number of units sold by 20%, with all other cost levels and percentages remaining unchanged. Okay, so look, that's a lot. We'll write out our formula and then we'll come back and break it down again. So I'll read it one more time. So calculate the profit Whelan Limited would make if it reduced its selling price by 5%, increased fixed costs by 4%, and increased the sales commission percentage to 7%, and thereby increasing the number of units sold by 20%, with all other cost levels and percentages remaining unchanged. Okay, so look here, we're looking to calculate the profit. Okay, it's calculate the profit that Whelan would make. Okay, so we don't know what the profit is, but what's the crack with the sales? So they want to reduce its selling price by 5%, so it's going to go €40 multiplied by 95% is going to give us €38. Okay. The number of units will increase by 20%. So it's going to go 26,000 multiplied by 120%. So that would be 31,200. Okay. Then we're going to work out the variable costs. So we know that the new amount of units to be sold is 31,200. We know that. But what's the crack with the variable cost? Okay, so look, the selling price has changed, so we'll have to use the €26, but then we'll have to add the new commission. Okay, so the new commission, right? So they increased the sales commission percentage to 7%. So it's going to be 7% of €38, which is the new selling price. So we're going to have 31,200 units multiplied by the 26, which is the variable cost without the sales commission. And then we're going to work out the new sales commission. So if you multiply €38 by 7%, you will get a new sales commission of €2.66. That part there is always very difficult for students to get. So you just have to really break it down. Now, fixed costs, we're asked here to increase the fixed cost by 4%. So the fixed costs were 216,000. If you multiply that by 4%, then you are 104% or multiplied by 4% and add it on, you're going to get €224,640. And the profit is what we're looking for. So the profit is X. Right, so we're going to have 31,200 units multiplied by €38. That is €1,185,600. Then when we multiply these both out as well, we've got €894,192. And then minus €224,640, that gives me my profit. So my profit is, when we work all that out, €66,768. So that is the profit. Okay, so that one there was very tough. You have to just write out your formula: sales less variable costs less fixed costs is equal to profit. You have to then do any changes up above. Okay, so really digest the question, what they're asking you to do, and then underneath do all of the workings then underneath. Okay, and so €66,768 is your profit. So that is part 4 complete. Part 5 then, a little bit of theory. So explain what is meant by a step fixed cost and give an example. So step fixed costs are costs that are fixed within a certain range of activity but change outside of that range. So they're fixed and then they change outside the range. So basically it would look like this instead of just being a fixed cost. So a fixed cost would just go over like this. Step fixed cost just looks like a set of steps. So an example could be, for example, rent could be fixed up to a certain level of production. However, if production increases and results in the rental of more factory space, then the rent would increase to a new level. Thus, the fixed cost would increase in steps. Okay, so that's the theory part there. So rent, you need more space, the fixed cost will go up. Okay, and then it'll remain the same until you might need more space then again. Okay, part B of the question then. So this is the marginal and absorption part. So part B, Aldridge Limited produced 15,000 units of product A during the year ended 31st of the 12th, 2019. 12,000 of these units were sold at €4.20 per unit. The production costs were as follows. So direct materials 70 cents per unit, direct labour 60 cents per unit, variable overheads 55 cents per unit, fixed overhead costs per year €8,400. Okay, what's required here? So part 1, prepare profit and loss statements under marginal costing and absorption costing principles for Aldridge Limited. And part 2, outline the differences between marginal and absorption costing. Indicate which method should be used for financial accounting purposes and explain your answer. Okay, so marginal costing, we've just seen what happens there. What happens there is that they split up variable and fixed costs. And that's really what we're going to be looking at here. This is a very easy thing to do, but a lot of students will mix them up. Okay, they might find it a little bit difficult. Okay, but it is a very, very, very simple thing to do. So look, with regards to absorption costing, right, we put in all of the costs together, okay, before we calculate the closing stock. But with marginal costing, we separate the variable, then we calculate the closing stock, and then we take away the fixed overheads. Okay, so let's just talk it through. Okay, so in absorption costing, they did sell 12,000 units at $4.20. So they didn't sell all of the 15,000 units that they produced. Okay, so Then we take away the production costs. So they did produce 15,000 units. So 15,000 units multiplied by 70 cent is 10,500. Direct labour, 15,000 multiplied by 60 cent is 9,000. And then variable overheads, 15,000 by 55, 8250. Okay. Then we also put in the fixed overhead here. So the total cost under absorption costing is 36,150. And then because we didn't sell 3,000, so we only sold 12, so we had 3,000 of the 15,000 units left, so 20%, we're going to calculate the closing stock, 20% of all of the production costs. So that works out to be 7,230 closing stock, which we take away from 36,150, and that gives us 28,920. And take that away from our sales, we get 21,480. Okay, so that is the profit under absorption costing principles. Now you can see with the absorption and marginal, we are the exact same. We have the exact same information down as far as the variable overhead, except as we said, we tot up all the variable costs, and we get total variable cost there 27,750 euro. And we calculate the closing stock based on that variable cost. So the variable cost there, 5,550 is the closing stock based on total variable cost there, 27,750. We take that away then from our 50,400, and so as you know, our variable costs taken away from our sales gives us a contribution, 28,200. And then what we do, we take away the fixed overheads then of 8,400. And you can see that the profit figure is different. It's 19,800 euro, okay? Because under marginal and absorption costing, you know, the closing stock is just valued differently. Okay, so just remember that in marginal costing, we just work out what the variable costs are first and calculate the closing stock based on the variable, whereas in absorption costing we tot up all the costs and calculate the closing stock based on all of the costs. Okay, so that is the profit and loss statements under marginal costing and absorption costing principles for Aldridge Limited. The next part of the question is saying outline the differences between marginal and absorption costing, right? So what is the difference? So there is a difference in the profit figures because closing stock is valued differently. So marginal costing does not include fixed costs when costing a product, whereas absorption costing does include the fixed costs. Therefore, closing stock under marginal costing is valued lower than under absorption costing because a share of fixed costs is included in the value of stock under absorption costing, but not included under marginal costing. Under absorption costing, closing stock is valued at 20% of the production cost of 36,150. Under marginal costing, closing stock is valued at 20% of the production cost of 27,750. So closing stock under absorption costing is 7,230 and under marginal costing is 8,400 euro. Okay, I'm sorry, closing stock is 5,550. Okay, so there's a difference between the two of 1,680 euro. The profit difference then, the difference between 24,480 and 19,800 is 1,680. And it says that absorption costing should be used, okay, when preparing statements because it agrees with accounting standard practice and concepts and matches costs with revenues. So you'd have to mention all of those things there to get full marks in that part too. So that is the 2020 costing question complete.